Today you are going to learn foreign currency transactions, how to account for foreign currency transactions. The relevant accounting standard for foreign currency transactions are LKS 21, the effects of changes in foreign exchange rates. So this accounting standard helps to prescribe how to include foreign currency transactions and foreign operations in the financial statements of an entity, and also how to translate financial statements into a presentation currency. So I'm sure when you heard these two, you are not having a good idea of what it is. So basically, LKS 21 deals with uh, recording transactions that are incurred in a currency other than the local currency. For example, if a company in Sri Lanka, if they incur transactions using any other currency other than the Sri Lankan rupee, that is a foreign currency transaction. For example, companies may purchase goods from the raw materials from overseas for their manufacturing, especially for manufacturing garments, for example. So they may purchase required raw materials from other countries. So that is a transaction, that is a company for their raw materials, company has to settle the purchase payments in foreign currencies. They have to make payments in the countries from which they have purchased items. For example, if it is a garment, if they source their raw materials from India, they have to make the payments in Indian rupees. If they have sourced material from Britain, UK, they have to make payments in pounds. In euro, if in any of the European countries, so they have to make in euros. So likewise, the similar to purchasers, sometimes companies sell goods overseas, especially the companies, those who engage in exports sales. So they get money in foreign currencies. So they incur exporting, they get income from foreign currencies. Other than that, for example, if a company wants to purchase equipment or a specialized specific machinery from overseas, so they will be taking those items overseas and they have to make payments in foreign currencies. So those are just examples of transactions that companies engage in using currencies other than their local currencies. So that's the background we are looking at under this topic. So I will just take you to a company annual report before starting the lecture for you to just to make a sense of what we are going to talk today. 1 minute, I will take you through the annual report of Lkas Spence. I hope now you can see these, the Lkas Spence annual report. Yes, I have shared it now. Lkas Spence annual report. You see, this is the annual report of the Lkas Spence. We will just have a look at the company. So what's the nature of its business and all. Just to now I am on the page. We'll see the page 209 of the report. Just you can see on the board, reporting entity, Lkas Spence, the company is a public limited company, incorporated and domiciled in Sri Lanka. And the ordinary shares of the company is listed in the Colombo Stock Exchange, and the principal office is in Sri Lanka. And the company's consolidated financial statements are prepared for the 31st March 2020. That means the consolidated financial statements means the group companies. That means when a company is having number of small companies owned by them, so they are known as subsidiaries, or maybe the Lkas Spence company itself, they have a parent company or a mother company in some other country. When all the companies belonging to these companies taken together, we treat it as a group company. For example, it says these 8 companies, the parent company, mother company is the 8 and that company's mother company, or else the ultimate company, is also called Milford Export Ceylon Private Limited. So this is just a structure of the 8 including its parent companies and a group of companies. And so with that, we will just look at yes, where we will just look at the nature of businesses of this company, and also just look at this company's nature of business. I will take you to page 9 of this company for you to get an understanding about the nature of business of this company. Just look at this page 9. So this shows the nature of business of this company. So their businesses are in the field of hotels, destination management, airline, then the maritime and port services. They engage in freight forwarding, logistics, education, and as well as power generation, printing and packaging, apparel manufacture, plantation. So just see, they are a conglomerate, including diverse business operations, money transfers, elevate agency, insurance, property management. So they are the business coverage. They are earning revenue from various types of income sources. So they operate through number of companies. You can see they operate in 9 countries. So they operate in Sri Lanka, they operate in Maldives, Fiji Islands, Bangladesh, Oman, India, Mozambique, Myanmar, and South Africa. So this is the 8 companies, the operating countries, and as well as the business areas where they operate. Okay. With that background, again, we'll go back to page number 210. I have uploaded this report in the LMS for you to have a go before starting the session, just to get an understanding about the nature of real reporting nature of companies. And we'll go to page number 210 now. This is the audited financial statement page. So where they talk about how they have recorded the transactions that involve foreign currencies. Okay, let me take you to page number 210. Okay, page number 210. Just see. Now, this is the audit report, audited financial statement of the 8 companies, annual report for 2019 to 2020. So now we are referring to the notes page of the financial statement. Now we are referring to note number 2.5. Okay, just see functional and presentation currency. So they are talk about currency, and 2 wordings there, functional currency and presentation currency. Just have an idea of what they are. Items included in these financial statements, that is the financial statements of the 8 companies, are measured using the currency of the primary economic environment in which the company operates. So that is known as a functional currency. So here they have identified their functional currency is Sri Lankan rupee. Functional currency is Sri Lankan rupee, and the functional currency is the currency of the primary economic environment in which the company operates. The economic environment in which the company operates So that currency is known as the functional currency. Just have an idea of what it is at the moment. And also just see, the financial statements are presented in Sri Lankan rupees. Financial statement, now what you see, the figures in the financial statements here are shown in Sri Lankan rupees. All financial information presented in rupees have been rounded to the nearest 1,000. And else, okay, that's okay. And also each group company, as I mentioned, the group company means now this company, Aitken Spence, have number of companies owned by them. Those are called subsidiaries. And as well as this Aitken Spence company itself is owned by some other company. That is called a parent company. When all these companies are taken together, it's called a group company. So when financial statements are prepared for all these group companies, it is called the process of consolidation. You have not learned those consolidation accounts still. So when you are in the next year, you will be learning how to prepare consolidated financial statements. That means you are going to amalgamate financial statements of all the companies that is owned by the parent company. Now, here, now you can again go back to this note. Each group company determines its own functional currency. Now you know what is the functional currency. Functional currency is the currency of the entity in which it in which, that means the country in which it carries out its main economic activities. Main economic activities are what? The purchasing goods, then selling goods, making payments for purchases, salaries and wages. So the country in which all those primary economic activities are carried out, so that country's currency is known as the functional currency. Okay, so it says when the financial statements are prepared, so these the financial statements have been prepared using the functional currency. And they say, so it has been consistently applied throughout the years, that is similar to the previous years as well. And also it says functional currency of all the group companies is Sri Lankan rupees, in Sri Lankan rupees. Functional currency of all group companies, all the companies belong to this Aitken Spence, their functional currency, or the currency in which the primary economic activities are carried out, it's Sri Lankan rupee. But other than following companies, so they have given a list of companies, their functional currency is not Sri Lankan rupee. Now what is functional currency? Functional currency is the currency of the primary economic environment in which the company operates. Now just see, when we look at these companies, Aitken Spence Hotel, its country of operation, incorporation is Sri Lanka, but its functional currency is not given as Sri Lankan rupees, but it's given as United States dollars. So therefore, they have identified this given list includes their companies, but their functional currency is not Sri Lankan rupees. Just this information now just for you to have an understanding about the level of engagement by companies, to the global world, to the global level. So they are having diverse operations worldwide, with subsidiaries and with parent companies, and as well as through imports and exports. So when it comes to this company, they have large number of subsidiaries and foreign operations, and so they are operating with different functional currencies. So when it comes to Aitken Spence Hotel International, it's incorporated in Sri Lanka, but its functional currency is United States dollars, not Sri Lankan rupees. Then the next company, again, US dollars. But when it comes to ADS Resorts, it's incorporated in Maldives, and it's again, functional currency is not Maldives currency, it's US dollars. Again, all the other companies listed here, so their functional currency is identified as US dollars. And just see another company, Aitken Spence Resort. Middle East LLC, it's the country of incorporation is Oman, and its functional currency is Oman Riyal. And another company, India, their functional currency is Indian rupee. And again, just see this one. Again, there are several companies incorporated in India, and their functional currency is Indian rupee. Country of incorporation and the functional currency is similar. Here, what you have seen, the country of incorporation is Sri Lanka, but its functional currency is not Sri Lankan rupees. That is different. So this is the functional currency is determined based on the economic environment in which it operates. When it comes to when we decide in the economic environment in which operate, that is not the country of incorporation. So that is where they conduct their main transactions, the purchases, all the operational items, they are conducted in operational currency or the functional currency of US dollars. So they have some companies, again, they incorporated in Fiji, and their functional currency is Fiji dollars, Bangladesh and Taka, Myanmar, Kyat, Jesse, likewise. So the information given, again, we will go to page number 314. So I'm just showing you for you to just get an idea about the company's engagement in foreign currencies and how they are being used in accounting. So now we are going through their audited financial statement. Now we will go to page number 314. Now I am taking you to just page 314. Further down, yes, 330. And also just see, now look at this note number 314. Notes to the financial statement, foreign currency translation. Now again you have heard one word, functional currency, and again you are learning a new word here, foreign currency translation. The word translation, they have mentioned the principal exchange rates used for translation purposes. Note number 45 disclosed, as we have seen, they have a number of subsidiaries and the foreign operations situated in different countries. And so when those companies are being taken into consideration for the purpose of preparing Aitken-Spence consolidated accounts, they have used that country's own currency. For example, so we have seen number of countries where they have incorporated and as well as their functional currency. So they are given here in the note. You can see the euros, British pound, Oman Riyal. The opening rate. Opening rate is the rate on the date of at the start of the accounting year. And as well as it's given at the, 2019 at the start of the year, and also at the closing rates given on the balance sheet date or the statement of financial positions date, year-end dates, figures are also given. So with that, now you can just see how the companies are dealing with different number of foreign currencies, and there is a wording called currency translation and the functional currency. Okay, with that, now I will okay, with that we will just see now. So with that, I will just go back to the topic we are talking about. So we are today we are considering about foreign transactions that are taken place using foreign currencies or foreign currency transactions. You know, as we notice, companies, when companies trade overseas, they will buy or they will sell assets in foreign currencies. They will buy assets in foreign currencies, or as well as they will sell assets in foreign currencies. As I mentioned, for example, buying materials from some other countries, and they have to pay for them in their own currencies. If we buy items from India, we have to pay in Indian dollars. And also, if we export items for finished products, we will be getting money from their currencies. Okay, and as well as if we, for example, suppose we have sold goods during the year and we have not yet received money at the end of the accounting period. So we are showing on in the accounts. So this amount is owed. This amount is to be collected. Either we have to pay this much of amount to foreign countries, or this much of money we have to be collected. So in the accounts, we show them in Sri Lankan rupees, but in the real sense, they have to be get or they have to be paid in foreign currencies. And with that note, you have noticed when we talk about foreign currencies, so they are always fluctuating. We don't have the constant exchange rates every time. Every time means like every time it's daily changing, monthly changing. It has a variation. It's not constant. So when the foreign currency exchange rates are not constant, so we are just when we are to record these transactions, so we are at risk, or we are at a level, we have to consider the movements of these foreign exchange rates as well. We'll see why we have to bother about foreign currency exchange rate fluctuations. And as we have discussed, the eight conspens, they have subsidiaries abroad. That means the company is owned by this company. And so when it comes to those companies, they engage in the supply of services, sales of items, purchase of items in their own countries, own countries' currencies, like in the Fiji currencies or in the Myanmar currencies, in their own currencies. And when it comes to those companies, they are keeping their books of accounts in their own countries. If it's they operate in Myanmar, they will keep their books of accounts in their own currencies. If it's situated in India, they will prepare their annual accounts in their own currencies. But as I mentioned, I just mentioned the word group companies or a holding company, and the word consolidation as well. That means when all the companies are taken together, and if we are to assess the performance of these companies, we have to prepare the accounts known as consolidated accounts. That means we have to consolidate the results of overseas subsidiaries also into group accounts. In that case, we have to add all the assets of all the companies, liabilities of all the companies together to arrive at group performance. In that case, we cannot add assets together that have been recorded in different currencies. We cannot add liabilities together that have been recorded in different currencies. In that case, we have to use foreign exchange rates to translate those assets and liabilities into a common currency or to a presentation currency. Okay. As I mentioned, if the exchange rates are remaining constant for accountants, so as accountants, we don't have any problems. It's easy for us. Okay, but when the foreign exchange rates are changing, we are not in a easy process. We are not at an advantageous position. We are not in as accountants, we are not in a position. We have to bother about what happens to this foreign exchange rate, and we have to look into that. Okay, with that note, I will just start with a small sum. Now, just try doing this sum to understand what I am talking about. We will start with the question. Just you will get an idea about this. I hope you can see this question. Just try to do this on your own. I hope I have shared this. Yes, I have shared this. If you can see this, yes. I have given you a sum. See the sum. Suppose a company in UK buys a large consignment of goods from a supplier in Germany. So we are talking about a UK company. So they are purchasing from another company. So the UK company purchased from a German company. Just see, the order is placed on 1st May and the amount agreed for this transaction is 124,250 euros. UK company buys from Germany. So how they have to make the settlement? When it comes to UK's company, their currency is pounds. When it comes to Germans, the currency is euros. UK company has to make the settled payment in euros. How much? 124,250. It says at the time of delivery, the rate of foreign exchange was, it's given. The foreign exchange rate between euro and the local currency of the UK company, that is pound. The currency between, exchange rate between the two countries are 3.50 euros to $1 pound. So this is the exchange rate at the time of delivering the goods. Now the question is, how should the company in UK would record these transactions in its books of accounts? So it's a foreign currency transaction. It's a transaction incurred not in their local currency, that is not in pounds, but in euros. So they have received goods. The agreed price is 124,250 euros. And at that date, the delivered date, exchange rate is given. How this UK company should record this transaction in the books of accounts. And also, now you can solve it out. Now again it says, again, so the UK company has purchased this amount, 124,250. Now we have to enter it into the books of accounts of the UK company. How we are going to show it? You have to record it as a purchase. Purchase account or the inventory account you debit, and credit what? Credit, you credit to payable account. Accounts payable account credit, purchase or the inventory account debit. By how much? What is the value we are going to record? Are you going to record it in euros? Can you record it in euros? No, that is not the currency of the UK company. UK's company's currency is pounds. So you have to convert this 124 2050, that you have to translate into UK's currency, that is into pounds. How you are going to translate? The rate is given 124 to 250, you have to divide by 350. When you divide 124 250 by 350, you get the figure. So that amount, how much you get? 124 250 divide by 350, you get 35,500. So the amount that has to be recorded as purchases by the UK company is 35,500, purchase account debit or the inventory account debit, payable account credit. So that is how the transaction has to be recorded in the UK company or the local company in this case. And also it says when the UK company comes to pay the supplier, that means when it is to be paid, what happens? It needs to obtain some foreign currency. Yes. So by the time they have to make this payment, UK company has to buy the euros of 124 2050. By this time, however, what has happened? The exchange rate has altered. It has changed from 350 to 355. Now what happens? How much they have to pay? The agreed price is 124 250, but the rate has changed to 3.55. Now, what is the amount that has to be paid? That is not the amount identified earlier, 35,500, but it comes to 35,000. Now, just see what has happened. By the time goods were delivered, the company had to pay 35,500. But actually, by the time it has to be settled, the amount to be paid has become 35,000. That is why, because of the movement of the exchange rate fluctuation, 350 to 355. Now, how are you going to record this change? Already you have recorded the purchase or the inventory 35,500 and the payable amount 35,500. Now, when it comes to the point of payment, you don't have to pay 35,500. Only you have to pay 35,000. Then what you are going to do? You debit the payable account by 35,000 and you make the payment of how much? You make the payment of 35,000. But just see, you have already recorded a liability of 35,500. Are you going to pay the balance 500? No. That 500 you are not going to pay. It is the amount that came or that is a benefit you got because of the change of the exchange rate. So that is known as the foreign currency exchange gain. You can just see that is called foreign currency exchange gain. You can just see the answer here on the next slide. Initially, we recorded the purchase 124,500 divided by the exchange rate that was there on that first date. The amount was 35,500. You created the payable account. Now, whenever the exchange rates are changing, we are not going to change the purchase or the inventory account. It's not practical to do it. Therefore, we don't go and change that account. Instead, we do changes the actual payable or receivable amount. Whatever the difference, we identified as a profit or loss that resulted because of the conversion of the foreign currency that is due or receivable. Payable account we settle, the total amount we debit by 35,500. We pay 35,000 cash and the difference in the payable account is the profit on conversion. We identify that 500 in the income statement as foreign exchange gain. So that is how example for recording foreign currency transaction. So at the time of transaction happen and also later on at the time of actual payment. And also just go through this question also. Second example. Just suppose home company, that's a company in the home country in which it conducts its economic activities. That company sells goods to a Chinese company. Then Chinese company is the foreign company. Home company will say X. The X company sell goods to a Chinese company. And the agreed price is Chinese yuan 116,000. So once you sell to Chinese company, you have agreed to get the amount of yuan 116,000. Now it says the exchange rate is given. At the time of sales, exchange rate is 1 pound is equal to 10.75 yuan. 1 pound is equivalent to 10.75 yuan. Now, how are you going to record it? But it says, by the time of sale, you have agreed 116. Now, you can divide this 116,000 by 10.75. You can identify the sales amount as 7,000. We can just take 10,790. We can round off. You can identify 10,790 as sales and debit what? Receivable amount, receivable from debtor or the Chinese company, 10,790. Later on, what has happened? You have recorded sales and you have a debtor. Now, the amount you have recorded sales, you are not going to change it. As you did for the inventories, you are not going to change it later on. It will be there as it is. But what happens to the amount that has to be receivable? Because the amount, the exchange rate has changed later on, even though we had the amount of how much? 7,000, 10,790 to be received, how much we are going to get now? 116,000 divided by 10.8. Now you are going to get only 10,740. You are going to get only 10,740. So there is a difference of 50. 50 difference, you are losing 50. Earlier you recorded to be received 10,790. Now you are going to get only 10,740. So you are losing 50. That is called exchange loss. That is called the exchange loss. Again, we are not going to reverse the amount we identified as sales. Instead, we settle the payment 10,790. What the amount we recorded, we settled by paying 10,740 and we identify the balance amount as loss. So the answer is given here. So here in the answer, I have rounded off 10,790 into 10,800. So that's why the rounding off that is there. Okay. I think with these two examples, you have got an idea of what we are talking about by this, the foreign currency transaction. We have to record transactions that is incurred in a currency other than the local currency at the time of the transaction. For example, when goods are delivered and when goods are received. Later on, actually, when we are to really make the payment or when we are to really get the amount, that amount is going to be different because the change of the exchange rate. So when the amounts receivable or amounts payable are going to be changed because of the change of the exchange rate, always there arises exchange gain or a loss. So that has to be identified in the profit and loss account or the income statement as foreign exchange gain or loss. Okay. Another example. I have given another example. Now just see. Another company, another example given. Financial year ends in 31st December. And they have bought goods on 30th September. And the value is 40,000. 40,000 value goods they have purchased. And it has to be settled in 2 equal installments. That means 20 euros each. To be settled in 20 euros each. One is to be paid on 30th November and the other one to be paid on 31st January. Because our year ends in 31st December, you can notice we will have an outstanding balance of 20,000 euros to be settled because it's going to be settled on 31st January. And the exchange rates are given on 3 days. 30th September given, that is on the date the goods are being bought. Then again 30th November, that is the rate on the settlement of the first one. And 31st December, that is the year-end rate. And again 1st January, that is the opening rate. Now you are asked to pass the necessary accounting entries in the books of White Cliffs. So that's the UK company's books of accounts. How we are going to show this in the books. Take a minute and solve it. How we are going to solve it. Now just see in the example, so the company has to purchase the record. At the time of recording, the purchase, the rate given is how much? 1.60. They have purchased goods worth of 40,000 pounds and the rate given 1.60. Then how much they have to record? They have to record goods, purchase account or the inventory account debit $25,000 and trade payables have to be credited 25,000 pounds. So that is on the date of the purchase. On the date of the purchase account debit of 25,000, payable account credit 25,000. Then that amounts to the cost of goods purchased. Then what happens? On 30th November, company should pay 20,000. When they pay 20,000, the rate is given 20,000 divided by 1.8. The rate is 11,111. They pay how much? 11,111 on when do they pay? 30th November they pay 20,000. When you divide it by 1.80, you are really making 11,111 payment by cash, and the amount settled is you debit a trade payables account. You are debiting 12,500. Why? The total amount is 25,000. You have recorded as payable and half is settled. Half of 25,000 is 12,500 settled. The difference between the amount you paid, that is 12,500, and the amount you really paid, 11,111, the difference goes to exchange gain account, that is 1,389. That is how you have to record it. Again, what happens on the 31st December, you have a balance of 20,000 because only the first installment is given. Now again you have to translate it using the given rate 1.90. Then you get a figure of 10,526. So you have to record it as a payable. Payable amount is 1,974 and you have to recognize the exchange gain of 1,974. Accordingly, you come across with a total exchange gain of 1,389 plus 1,974. You are recording a total gain of 3,363. Then on 31st January, when the company pay the second installment of 20,000, then how much they are going to settle? 20,000 divided by rate is 1.85. Then you pass the entry, fourth entry, trade payable account, you debit 10,526, you pay cash 10,811, and exchange loss account, you incur a loss of 285. So that is how you have to record the transaction. Okay. Oh, you didn't see the answer. Okay. So this is what we were discussing about. Yes, this question. So we were discussing about this question. So you have to record how much. You have to record when you purchase this one, you have to record on the 30th September how 40,000 divided by this rate 1.6, then you get 25,000. 20, I'll take the pen. 25,000. Purchase account debit 25,000 purchase account debit 25,000 and payable account, trade payable account, you get 25,000. Okay, that is the first entry you have to pass when you get goods. So what you did, you translated this 40,000, this euros, using the exchange rate of what? 160. You divided this by 160, then you got this 25,000. Okay, so after that what happens? So you pay the payment on 30th November. How much you are going to pay? You are going to pay half of this. Half of 40,000 is 20,000 euros you are going to settle. So you are going to settle 20,000 euros. How much? The rate. Rate is 1.8. 20,000 euros. Rate is 1.8. You are going to settle how much? 11,000. You are going to pay cash. Okay, you are going to pay cash 11,111. You are going to pay. And you are going to settle the payable balance of, you are going to pay the payable balance. Out of this payable balance, you are going to pay half, 12,500. You are going to settle half, 12,500. Then what's the difference? The difference is, difference between 12,500 and this 11,111, the difference is 1,389. What is that? That's the gain, exchange gain. That is exchange gain. This gain you got because of the fluctuation of the rates. Rate increased from 1.60 to 1.8. Thereby you got a gain of 1,389. You record it in the income statement as exchange gain. Then again on 31st December, what you have to do? 31st December in accounts you identify how much? You are identifying this 1,389 amount as the exchange gain. Okay. Then on 31st December, you have to record this balance 12,500. 31st December, you record this 12,500. That is on 31st December, you record this at the rate of the 31st December. That is 1.9. 12,500 you divide by 1.9. Amount is how much? Okay, again on 31st December, what we have to do? The figures go on. Okay, on 31st December, what we have to do? So we have to record this, the balance amount payable, that is payable in January, 20,000. We have to translate using this rate, 1.90. Once you translate this, convert this using this one, the amount you get, how much? 20,000 divided by 1.9, that is 10,526. Okay, you get 10,526. Whereas we have recorded amount of 12,500 as payable. We have recorded 12,500 as payable. What is the difference? Difference is 1,974. So this is again an exchange gain. So you record this 1,974 as exchange gain. You credit this amount and you debit payable account. Payable account you debit by 1,974. Payable account you debit by 1,974 and exchange gain account you credit by 1,974. Okay. Altogether, during the year, how much you have identified as exchange gain? 1,389 in the earlier case as exchange gain, and here 1,974. Altogether, you identify how much? As gain 1389 plus 1974, you identify 3363 as exchange gain. Okay, exchange gain. Again, on January 31st, what you are going to do? On January 31st, you are again settling on this date how much you have to pay. You have to pay how much? You have to pay cash. You are going to settle this one. Payable account debit 10,526. You are going to settle. But on that day, you have to pay how much? The rate is 1.85. You have to pay only 10,811. You have to pay only 10,811. Then you get a exchange loss of 285. Exchange loss of 285. This is payable account debit, exchange loss account debit, and the cash account credit 10,811. So that is the entry what you have to pass. So what we have been doing all these transactions, in all these transactions. Let's see here what we have been doing. We just have a go again. So here what we did, at the time of purchase, when the goods are received, they are recorded using the exchange rate on that date, either as sales, either as purchases. So on the year end, again, we have to translate, or we have to convert the amount that is lying as receivable or payable using the exchange rate on that day. So when we do this translation, so if there is a difference, if we have to pay more than the amount what we have recorded, that is identified as an exchange loss. If we have to pay lesser amount than the amount we have identified, it is identified as a exchange. If we have to pay less than the amount we have identified, it amounts as a exchange gain. So that is what we did here. And again here, we did that one, and here we have identified again what happens when it comes to sales. Sales are identified on the date of the transaction, and later on when it is to be paid, we again translated the amount that's to be receivable on the subsequent date using the rate on that date. So whatever the changes we come across, that is identified as exchange gain or loss. So that is what we have discussed. And here we have identified, we have to do done this translation at several times. First, we have to do it on this date when the goods were received. When the goods were sold, we had to record this first as purchases. Again, we had to record this one when the first installment was paid. Again, we have to translate the amount that is to be payable on 31st January on using the rate that was on 31st December. And actually, when the second payment was done, we had to translate again it on 1st January. Okay. So if you need, I will provide the written answer for this one again after the class. So with the slide. So with that examples, now I think so it's easy for you to understand what we are talking about. We will erase this. Okay. 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 Now, so I'm going back to basic. So maybe it was difficult for you to understand because we started with the sum, but I feel now it's going to be easy. Exchange rate. So now we discussed about exchange rate between euro and pound. What is this exchange rate? It's the ratio between a unit of one currency and the amount of the other currency for which that unit can be exchanged for at a particular time. So if exchange rate is the rate between two currencies. If we are to pay, when we are using two currencies, how much we have to pay to get other currency. So that's the rate, that is the exchange rate. Then the purpose of the accounting standard is to give guidelines to prescribe how these transactions should be recorded in the books of accounts. So these transactions are mainly two types. It can be foreign operations, as I mentioned, when companies operate in other countries, maybe through branches, subsidiaries, so that is considered foreign operations, or they may engage in exports and imports just by operating in the home country itself. Okay. These are the examples. Do transactions in foreign currencies, import, exports, taking loans, maybe the purchasing raw materials, purchasing machineries, equipment, and also, as I mentioned, having foreign operations as a parent, subsidiary, or a branch. What are foreign operations? They will be established in the form of a subsidiary, associate, or a joint venture. You will be learning those things in the second year. It's just for this lesson, just say it's a way of operating in some other countries as another branch of the parent company. Okay. Now, as now you came to know two words. One is functional currency, other one is we didn't talk about presentation currency. We have to talk about another currency known as presentation currency. What was the functional currency? As we identified, it is the currency of the primary economic environment in which the entity operates. As we understand, so where the company is established and incorporated, it is not the functional currency. Functional currency is the currency of the primary economic environment. Primary economic environment means where the company purchase goods, sell goods, and also where they make payments for employees and services. So what's the currency used for? All those things. So that is the functional currency. For most companies, functional currency is the currency of the country in which it is located. If it is a Sri Lankan company, the functional currency is Sri Lankan rupees. And if they carry out most of their transactions in Sri Lanka, so it gives you a chance to decide your functional currency as the Sri Lankan rupees. If a country or if a company use any currency other than their functional currency, that is known as foreign currency. Foreign currency is a currency other than the functional currency of an entity. Then what is the presentation currency? This is another one. Functional currency and the presentation currency is the currency that is used to present the financial statement. For example, when it comes to expense, they had number of operations in some other countries. So for example, the company in Fiji, they will prepare their accounts using their functional currency, Fiji, using the Fiji currencies. Maybe in Maldives currencies. But when they are to present it as a group, that currency, that transactions or the organization's financial statement has to be translated into, we'll say the Sri Lankan rupees, because expense is now present in the group accounts, financial statements. Therefore, they are foreign operations accounts that have been prepared using functional currency has to be translated to Sri Lankan rupees. That is called presentation currency. You also need to realize that an entity can actually choose its presentation currency, but cannot choose functional currency. I hope you got the point. You can think what currency we are going to use as the presentation currency. That is for the purpose of preparing financial statement. But functional currency cannot be something that is to be judged. That is the of the company, that is where all the material transactions, economic activities are conducted. So for that one, they cannot take a judgment. So it has to be come from the economic environment in which it operates. But when it comes to presentation company, they can select any currency as they want. When you go to the accounting standard, so there are factors given for you to decide the presentation currency, and as well as to it give indicators how the functional currency or the economic environment is operated, the identify. You can just have a glass. Again, this is basic. Foreign currency transaction is a transaction that is denominated or requires settlement in foreign currency, including transactions when an entity buys or sells goods. You buy goods, sell goods, but their prices are denominated in a foreign currency. Similarly, you borrow or lend funds. The amount you have to be paid or receivable, it's in foreign currency. Or you acquire or dispose assets, or you settle liabilities that's not used in the own currency or the local currency, that is using foreign currency. Foreign exchange rate and the relevant date. Now, when you go through the example, you identify foreign exchange rates, the different dates are given. Transaction date rate, again the year-end date, actual settlement date. So you could observe different dates were there. Foreign exchange rate and the relevant date. The date of a transaction is the date on which the transaction first qualifies for recognition in accordance with SLFRS. For example, when it comes to the purchases, which date rate you are going to take to record the purchase, whether it's the date of the agreement or actually the date on which they received goods. According to the accounting standards, so you have to take the real date of the transaction, the goods were exchanged, the date of the transaction on which date they got goods, the risk and rewards past date, that date. So that is the date you have to take for recording transactions either as purchases or sales, not on the date of the contract. But when it comes to sales, for example, you see you engage in export sales every week or every fortnight, you make shipments. So practically it's difficult for you companies to keep track on foreign exchange rate every time. So you send a shipment today, again in 2-3 days time you send another shipment. So again, when you want to record, we say the export sales, you have to follow these foreign exchange rate every day or every 2 days time to identify the exchange rate. Practically, it's not easy. Therefore, for this type of transaction, you can use an average rate. For example, you can enter all the sales transactions and all the purchase transactions at the end of the month or at the end of each 2 weeks time. So for that purpose, you can take the monthly average rate or weekly average rate as the exchange rate to record these transactions. So thereby you are not going to record, you are not going to use different or individual exchange rates to record transactions that is being taken on daily basis. Instead, you use an average rate, maybe a weekly average rate or a monthly average rate to record transactions. You can do it if there are no huge fluctuations in the exchange rates, okay? So, and we use the words conversion, translation. So what's the difference? There are two distinct types of foreign currency transaction. We talked about conversion and translation. So when we buy goods from some other country, so as a UK company bought goods from Germany, they had to pay, settle in German euros. They had to settle in euros. So at that point, what's the relevant word? Is it conversion or is it translation? So that is conversion. Conversion is the process of exchanging amount of one foreign currency for another. You have to translate the UK company's pounds to euros. So it's called conversion. What happens in a foreign currency translation? In a translation, actually there are no exchange of money. Nobody exchange money for translation. At the translation, what is done is on a particular day, that is at the end of the counting period, we recalculate whether the amount recorded in the books of accounts as receivable or payable, does it reflect the actual amount that is to be settled really after the counting period. So by considering the exchange rate deviations, you calculate at what rate we should record on the balance sheet date or the year-end date. So on that date, what we do is this translation. So there we do a translation. There are no any movements of currencies happens. What happen is it is done at the end of the counting period when a company, if it's still hold assets or liabilities, that means receivables and payables are there on the balance sheet date, then that amount has to be translated using the exchange rate on the balance sheet date, as we did in the previous example. For the second installment, 20,000, it was due on 31st January. Therefore, on the balance sheet date, the 20,000 that was due, we had to translate using the amount currency of 1.9. So when whatever the difference, we identified as a gain or loss. Again, very basic things. Now, exchange rate is the rate is the ratio between two currencies. Spot rate. Spot rate is the rate that is used to record immediate delivery. If you sold goods on a particular date on that transaction is the spot exchange rate. The date on which you record goods, receipt of goods, that is called spot exchange rate. Closing rate is the rate that is on the accounting date in period. Exchange difference you identified when we translate existing amount payable or receivable using the closing rate, we get a difference, that is exchange rate. When we translate currency from one currency to another, we get exchange difference. And the fair value, so you are familiar with this one, fair value. So that's the price that one would get by selling an asset in an orderly transaction in a market. Now you are familiar with the group. As I mentioned, group includes number of companies. One is called a parent and the other companies are called subsidiaries. Taken them together is called a group of companies. And again, you come up with a new wording here, monetary items. Monetary items. What are monetary items? Monetary items. Monetary items, then the other opposite of this is non-monetary items. What are monetary items? Monetary items are units of currency held. That means currency held, cash and bank amount held on the balance sheet date. And assets and liabilities to be received or paid. That means trade payable, trade receivable. The amount is fixed. How much to be paid, how much to be received is fixed. And the amount of money lying in the accounts or in the cash is there. Those are called monetary items. You can see some examples I have given. Okay, these shows examples for monetary items. Either cash, cash equivalents, debt securities, amounts receivable, payable. Those are, so here it's under assets, that's why the payables are not there. Monetary items. The characteristic is those are received in fixed or determinable amount of cash. How much to be received is certain. Those are called monetary assets. Then we will move to monetary liabilities. Next. non-monetary assets. You know what are monetary, cash balance and the amounts receivable. Then non-monetary are, what are those things? They don't have a fixed amount that is to be received it's not an amount that's to be received in the future. Example, inventories. So the amount, how much to be received in the future, it's not fixed. What we record is the cost of inventories. Prepaid expenses, equity securities, PPE, intangible assets, those are examples for non-monetary assets. You need this classification because on the end of the accounting period, you have to translate monetary and non-monetary assets using exchange rates. Then for monetary assets, we are using one rate and non-monetary assets, we are using another rate. We will see. You can just go through these details later on. Now we will come to monetary liabilities. Monetary assets are accounts receivables and the cash, and monetary liabilities are accounts payables, accruals, lease payable, because the amount is fixed or that can be determined in terms of cash. Monetary liabilities. Non-monetary examples, deferred income and government grants. Okay. So with that, now you can see this example, this one, why this discussion is important. Okay. Why this discussion is important. Foreign currency transactions, when we are recording the foreign currency transactions that were recorded in functional currency, how we are going to record them later on. Transactions that were recorded using functional currency, when we are to record them subsequently, how we are going to record them. Monetary items, now you know cash and the amounts receivable, that is monetary items, how we are going to record them later on the date of the transaction. You recorded using the functional currency, using the date of the transaction or the spot rate. Monetary items, when you are reporting later, you have to use the rate at the reporting date. Reporting date means if it is the year-end date. Okay. When it comes to non-monetary items, for example, inventories and the PPE, those things, non-monetary items, what's the rate we are going to use? We are not going to change the rate. That is the rate at the date of the transaction, historical rate. You are not going to change the amount that was recorded when they were purchased. If you purchase assets today, how much you have used, the exchange rate, the same amount will be appeared in the books of account on the year-end date as well. However, if items are revalued, we have to take the rate on the date of the valuation. Okay, those are how the foreign currency transactions that were recorded using functional currency are subsequently recorded in the books of accounts later on. Monetary items, that is cash and receivables, as you observed on the balance sheet date, we had to translate them using the rate on the year-end date. But when it comes to PPE and the inventories, we don't do it. It is recorded at the price we recorded originally. If any of the items were revalued, for example, PPE, if they have been revalued, we have to take the rate on the date of the revaluation. So this is the summary. So you come across with exchange gain and losses when we translate items using the exchange rate on the year-end accounting period. Then you come across with exchange differences. That is charged in the profit or loss account. Profit or loss account may be unrealized exchange differences. For example, receivables at the time of recording it, we record using one rate. On the accounting year end, we record it again, translate it using another rate. So between the two dates of the transaction, we will come across with exchange gain or a loss. It is actually not realized. Why? It will be paid or received subsequently. Until it is really happening, it is unrealized. So that is why it is called unrealized exchange differences. So we will not go into much detail. Can just go through these. Okay, so this is what we were discussing. How to report transactions in functional currency, subsequent reporting. That is at the end of the each reporting period, that is on the accounting year end, what you have to do, you have to translate all these assets and liabilities that is recorded in foreign currencies into functional currencies subsequently. How we are going to do is all the monetary items we have to translate using closing rate. Closing rate is the rate on the date of the accounting period end date. All non-monetary items we have to record it using the historical rate. Historical rate is the rate on the date of the original transaction. All the non-monetary items that have been measured using the fair value has to be translated using the fair value at the date of the transaction. You can just go to this IFRS site for more information. Okay, that is again a summary where you have to record, as I mentioned, when all the exchange differences has to be identified in the profit or loss account. Okay. For example, it says when gain or loss on a non-monetary item. For example, PPE, if any PPE items gain or loss is identified in the comprehensive income, if it was identified originally in the comprehensive income, any change, any subsequent changes should be identified in the comprehensive income statement. Okay. If anything is identified in the P&L, profit or loss account, subsequent should profit or loss also should be identified in the profit or loss account. So again, summary, assets and liabilities, we have to report at the rate at the reporting date. Income and expenses, we have to take, as I mentioned, transaction date rate or the average rate. All equity transactions, the share issues and all, gain rate of the transaction or the average rate. Okay, with that, we will now go to this one. Okay, just you can just go for more information here. IFRS doc here. What is the objective of IAS 21? Just see foreign currency versus foreign currency. Just see summaries. Functional currency, presentation currencies, how it is being done. All the additional information are there. Just see. You can go through this for additional information. Okay. Let's see. Can listen to.
Companies develop foreign activities to spread their businesses beyond the borders. There's about 150 different currencies. Foreign exchange rates constantly change and move up and down. So how record all these foreign activities Let's find out in this video with a summary of IAS 21 the effects of changes in foreign exchange rates. This is Investing data according to its activities and operations, so it's not choice. In general, the functional currency is the same as the this is not only the case. It is basically the process that influences services, companies like etc. And it also really depends on the transactions with a specific entity. Sometimes it's not really clear how the functional currency is. In this case, the management makes the judgment on it. Another way to representation funds is a funds individual ledger statements are presented. An entity can select its presentation funds and affect the balance hours. So imagine there is a physical entity, and this entity operates in Mexico. Majority of its expenses are in Mexican peso, so its functional currency will be Mexican peso in most cases. Let's say that there's a Mexican company sells goods to Mexico and doesn't use that, and it's interested in just and then it's initially, it means when the transaction occurs for the first time, payment or sale. All transactions are translated using the stock exchange rate, functional currency, and economic currency. This platform is now for European settlement, so running and stock exchange transactions. Subsequently, at the end of each reporting period, we shall translate this transaction report into inventory. Historical costs are not using the exchange rate at the end of the transaction that is historic. For example, non-monetary assets as an economic this is accurate assets are recorded at the exchange rate of the transaction. Now, how do we present the exchange rate differences in this process? Well, in general, people want to price other transactions. When you have some non-monetary money, you can valuation changes presented the foreign exchange component of this change will also recognize too. Also, management has information that affects impacts changes in the tax valuation taxes and sources of management. Here, the difference is expenses are translated by the transaction at historical date, but it can be impractical to translate each single transaction separately, so the average period remains used. In relation to equity lines like share capitalization, premium, and airlines, as the previous and the real estate research does not specify the most appropriate things used in historical rates, but I see the usage of real estate and it doesn't impact on the
Okay, I hope with that video you could expand your knowledge about what we discussed today. So we will not go into detail like how to translate accounts that are subject to hyperinflationary situation. So for your level, it's enough if you can understand how foreign currency transactions are being converted, recorded and converted subsequently. Basically, you should know how monetary and non-monetary items are to be translated on the accounting date, on a year end, how those have to be recorded on in the books of accounts. So, and also you should be familiar with how they have been actually recorded in a company. Just go through the expense financial statements and as well as the accounting standards to have a good understanding about that. So with that, I will stop the session. Okay, thank you.